as discussed before, the most important and commonly used ratio to gauge valuation of a company is PE ratio. The important point here is not how to calculate the PE ratio. That you can even find it online on tools like Screener. The important point here is how to gauge if a stock is overvalued or undervalued. So first of all, you need to understand that there are two types of PE ratios: trailing PE ratio and forward PE ratio. Trailing PE ratio is calculated by dividing the current market price per share of the company by its earning per share over the past 12 months. And forward PE ratio is calculated by dividing the current market price of the company by its estimated earning per share for the next 12 months. Now, when you invest today, you only care about future. You don't care about past. Although the past data, that is historical data, can give you a good picture of what you can expect in the future. But here the key is future earning. Now let us extend our previous example of TCS and try to understand whether TCS is overvalued or undervalued. So currently TCS has a PE ratio of 28. To know whether it is expensive or cheap, first of all you need to look at its median PE ratio of last 3 to 5 years and then compare it with its latest PE ratio. For example, its last 3-year median PE ratio is 32 and currently it is trading at a PE ratio of 28, which is below its 3-year median PE. Then its 5-year median PE is 29, which is similar to current valuation. This shows that TCS current valuation is slightly less than 3-year median valuation and similar to 5-year median valuation. That makes TCS fairly valued at current levels. So that's one way to gauge valuation. For example, HUL is a large cap company, yet it commands a PE ratio of 57. Generally speaking, a PE ratio of 57 is very high. But if you look at last 10 years of HUL PE ratio, its median PE is 60. It means HUL has always commanded a premium. So as compared to its historical 10-year median PE of 60, HUL current valuation of 57 looks decent. Second, you can compare valuation with peers in the same industry. For example, here you can compare TCS PE with Infosys PE. So TCS PE is 28 and Infosys PE is 21.7. It means TCS commands a premium as compared to Infosys. Now here you can't compare TCS valuation with Tata Elxsi that commands a PE ratio of 58 because TCS is already a large cap company with a market cap of 11 lakh crore rupees and Tata Elxsi is a mid cap company with a market cap of 41,000 crore. So TCS is currently 28 times bigger than Tata Elxsi. Moreover, the growth prospect of TCS and Tata Elxsi are different. Tata Elxsi is growing at much faster rate than TCS and would continue to do so. Mainly because A, Tata Elxsi is a mid-cap company and TCS is already a huge IT giant. And B, because Tata Elxsi caters to EV software segment that has much higher demand than other IT software. So even if there are two companies in same sector, you can only compare the peers at same level. Another example is ICICI Bank and HDFC Bank. You can compare valuation of both companies. But you can't compare ICICI Bank valuation with IDFC First Bank. I hope it makes sense. So if I summarize, the most important factor that decide PE ratio is ultimately everything boils down to the future earning potential, both profits and cash generation. A company with higher future earning potential will command a high PE and a company with lower future earning potential will command a lower PE. And future earning depends upon company's competitive advantage. For example, leaders in their sector always command a high PE. Example, Titan has a PE ratio of 76. Asian Paint has a PE ratio of 73. Now, is it expensive or cheap? So one way I mentioned is look at the historical median PE. Another way is, do they have a direct peer? Well, Titan doesn't really have any direct peer for comparison. Likewise, Asian Paint is 3.5 times bigger than its second competitor Berger Paint. So it won't be right to do peer comparison. Now, Titan certainly has a bright future. There's no doubt about it. But the question here is, does it justify a PE ratio of 76 for Titan that is already a large cap company and commands a market cap of 2.3 lakh crore? It is debatable. There's no simple answer to it. Personally, I find it expensive. To get a better understanding of valuation, you need to have a good clarity on the business model of various sectors like your banking, IT, pharma, manufacturing, and the growth prospect of each sector. And then you should know how to identify the competitive advantage of companies in each sector. In case you want to explore all this, I have a complete course on money management where I have a specific module on stock fundamental analysis that covers everything right from business model of each sector on how to do fundamental analysis of the company and so on. I have provided the link in the pinned comment. Again, let me repeat, a high PE ratio doesn't always mean that a company is overvalued, and a low PE ratio does not always mean that a company is undervalued. For instance, if you look at FMCG stocks like Nestle, HUL, Marico, Dabur, they all command a premium valuation. The reason is these companies are cash generating machine. Their business model is retail centric and they are the leaders in their respective sector. For instance, although Nestle and HUL are in same FMCG sector, Nestle is a leader in baby products, then coffee, then chocolate, then milk powder, then HUL is a leader in home and personal care products. So two different segments and both of them have great growth potential. Yes, you can always question that Nestle is already a huge giant with a market cap of 2 lakh crore rupees and its profit growth in last 5 years is 14%. So is it worth paying a premium with PE ratio of 83 to Nestle? That's again debatable. Then you have retail chains like Tata Trend that commands a PE ratio of 127, Campus Footwear commands a PE ratio of 98, then QSR chains like Jubilant Foodwork commands a PE ratio of 73. But that does not mean they are super expensive, because Tata Trend, for example, is in huge growth stage. Currently it is investing money in opening new stores that will generate earning in the future. And organized retail sector in India has huge growth prospects. So it will command a premium because of its earning growth potential in the next 10 to 20 years. Now the question here is, which companies commands a high PE ratio of 40, 50 and above? A, companies that are leader or among the leaders in their segment. Then B, the sector itself should have a bright growth prospect. And C, company should be a mid cap or small cap so that there is enough scope for growth. Example, Apple India currently commands a PE ratio of 49. This is after 30% correction in its share price. At its peak, Apple India PE ratio was 162, that was crazy. The reason for high valuation is its earning growth potential in the future. Company profits have grown at a CAGR rate of 64% in last 3 years, and considering the fact it is a leading player in mobile advertising that itself has a bright future, and Apple India is still a small cap company. So it is expected to grow at a much faster rate and hence it commands a high PE ratio. Likewise, Dixon is trading at a PE ratio of 73 after 36% correction in its share price. Again, the same reason for premium valuation, where Dixon is a leading manufacturer of LED TV, mobile phone, washing machine, security camera, and has also forayed into wearable devices. Since the future of consumer electronics is very bright, Dixon, which is still a mid-cap company, is bound to benefit from it and expected to grow at much faster rate. Then you have KPIT. Now everyone knows that EV software segment has a bright future prospect and KPIT is one of the leading player in the segment. Hence, KPIT will command a premium. Currently it commands a PE ratio of 65. Now you can't expect KPIT to trade at a PE ratio of TCS or Infosys at 25 to 30 PE. The only question is, how much premium is enough? A PE ratio of 40, 50 or 60? Well, that's a $1 million question and there is no perfect answer for this. Every person will have a different opinion and that's why you will always find both buyers and sellers for every stock. Likewise, you have metal sector that commands a very low PE. For example, Tata Steel commanded a PE ratio of 7.5 right before Q4 results. That's because metal sector is highly cyclical. Metal companies don't have a command over the end prices of metal, which is a commodity. It's based on demand and supply. So market doesn't like to give a high PE ratio to such highly cyclical stock. For example, after Q4 result, Tata Steel net profits have tanked 84% year on year and its PE ratio is now 16.7. Likewise, packaging sector stocks like Polyplex, Jindal Poly, Cosmofilm, Uflex have very low PE because they are essentially making commodity products and doesn't command a control over the product pricing. So the point here is different sectors command a different valuation and within that, different companies command different valuation based on their leadership, competitive strength, financials, then your future prospect, market cap, etc. Then valuation also changes based on macro environment. For example, during 2020 COVID, the stock market tanked badly and majority of stocks were trading much below their historical 3 to 5 year median PE. But then we saw huge liquidity pump and majority of stocks became expensive during 2021 bull run. Again, in 22-23 we saw liquidity drying up and majority of stocks became reasonable or even attractive. Now if you look at specific sector, during COVID, IT and pharma sector zoomed exponentially that made them expensive. But in 22-23, IT and pharma sector has seen good correction and that has made them fairly valued in 2023. Likewise, chemical sector has zoomed exponentially in 2021 and has corrected in 2022. Today, defense sector stocks are trading at premium valuation as compared to their past valuation due to government focus on Atmanirbhar Bharat and high order book of defense companies. So as a long-term investor, the best time is to invest is either you identify right stock before the bull run or during the bear market when the overall market sentiments are down and stocks are available at much better valuation. And third option is that if you find good potential in a business, then keep adding it in a systematic manner without worrying too much about the price. For example, KPIT is looking expensive at PE ratio of 64, so you can either wait for correction or keep adding a few shares in SIP mode. That way you will average out your buying price over the long term. Although PE ratio is again not a foolproof way to identify the true valuation. For example, sometimes earning falls due to external event, and when earning falls, PE ratio will increase. But it doesn't always mean that the valuation has become expensive. For example, over the last few years, auto sector stocks have witnessed a sharp fall in earning due to its various factors like COVID, then semiconductor issue, then sharp jump in metal prices, etc. That resulted in high PE ratio. But you need to look at the future earning prospects and then gauge the valuations accordingly. So in this video, we discussed the key parameters to gauge the valuation of a stock. And then we deep dive into PE ratio and how to check if a stock is overvalued or undervalued. One thing is for sure, it is not a cakewalk to identify the right valuation of the company. It requires a lot of experience in the market. Here, experience plays a very important role because valuation analysis is more of an art than science. And you learn this art when you spend more time in the market. As you get more experience, you learn how to value a stock. The most interesting part is that every company has its own set of growth trajectory and hence a PE ratio to it. But ultimately, a company is valued based on its future growth potential. Although in the short term, sentiments also play a key role in valuation, and sometimes markets get irrational and make a specific sector or stock overvalued or undervalued. And that's where you need to identify undervalued stocks where you can invest your money. I hope this video will help you get a good direction in terms of how to do the valuation analysis. If you find this video useful, do consider subscribing to the channel to get more such useful content in the future. I'll see you in next video. Till then, take care.